Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, running a small business, being self-employed. So today we're going to talk about the difference between bad debts and provision for bad debts. And before I get on to that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as finding other information that we have available on a whole host of different topics, all aimed at supporting you in your self-employment. So back then to bad debts. So I wanted to just explain the difference between bad debts and provision for bad debts. So firstly, let's consider what a bad debt is. So as we've talked about many times before, it's really important that you keep an eye on your debtors, on your customers that owe you money, and when those fall due, that you take steps to make sure that you keep on top of that you don't allow your customers to, without consequence, just pay you terribly late without any agreement to do so. So as part of that, there may come a time where, for example, you decide that the customer raises a query on an invoice, and you decide as a gesture of goodwill that you will reduce the value of that invoice. Now, that is something that you've come to an agreement with your customer for, so that is not a bad debt. You would simply issue a credit note for the amount that you'd agreed to discount. And in fact, even in that scenario, if you agreed that you wouldn't be charging your customer at all, that still wouldn't be, in that instance, a bad debt. You would simply issue them a credit note because it's something that you've come to an agreement with them to discount or remove the invoice. So the time when we would be considering a bad debt is when you have issued the invoice, you perhaps your customer has raised queries, but you don't accept their queries and you've explained those to them. You still expect them to pay you in full. Perhaps you may have previously offered a discount, a gesture of goodwill, and discounted the invoice via a credit note. But the amount that's now outstanding in your accounts from that customer, you do expect to pay. There's no reason for the non-payment. And again, we've talked in other videos about your options in terms of recovering that money. But let's say, for example, you decide that you're not going to pursue it. That is a bad debt. If your customer should have paid, you haven't come to any arrangement with them, or you haven't agreed for them to reduce the amount that they pay you or for them to not pay you, then that is effectively a bad debt. So in the respect of a bad debt where you decide that you're not going to pursue it, sufficient times passed, and you decide that you don't expect to receive the payment, you're no longer going to chase that payment, then simply that would be written off in your accounts as a bad debt. And I talk in another video, if you're using software, how you can actually facilitate that actual transaction. So what we're doing is we're taking that whole amount owed, that whole invoice or series of invoices, out of your accounts completely. But as opposed to where there's some agreement or some gesture of goodwill or some error that needs correcting, we're not issuing a credit note to reduce the sales. We actually want the amount to show in our accounts as a bad debt, so that at the end of our financial period, we can actually ascertain how much has been written off in bad debts. And this will help you to know whether your processes and your procedures need tightening, or whether it's an acceptable amount that you've written off in the period. So, of course, as long as that invoice or series of invoices, that debt from that the customer owes to you, stays in your accounts, then of course that is going to contribute to your profit, which fundamentally your tax is going to be based on. So there may be some time, particularly if the situation happens close to the end of your financial period, where you have a suspicion that you won't get paid for an invoice, but you are still chasing it, you are pursuing it, perhaps you're taking legal action to recover the debt, and of course that all takes time. So you're in this scenario, you're not ready to write the debt off. You don't want to remove it from the accounts because you still want to be chasing your customer, so you still want it to be there, but you think that perhaps you may not get paid. So in this scenario, at the end of your financial period, you would take if you're VAT registered, the net value, or obviously if you're not VAT registered, then the full value, and you would create a provision for bad debts. So that would actually, rather than actually taking out the sale, you would just be creating an item in your balance sheet which carried it forward into the next accounting period, but on the balance sheet, not in the profit and loss. Then in the next period, if your customer did pay you, then you would have likely have reversed that adjustment at the start of the year anyway, and then that would become a sale in the new period, because remember, by making the provision for the bad debt, you've taken the sale out of that original period and moved it to the balance sheet, and now you're going to take it back from the balance sheet and into a sale. If at the end of that period, the second period, you still hadn't received the payment and you had decided that you were ready to write it off as a bad debt, then you still would move it back to the profit and loss from the balance sheet, but you would be moving it to the bad debt rather than to the sale, so that was then written off and removed from the accounts and not carried forward. If you got to the end of the second period and you still perhaps were taking legal action, or for some reason it was still ongoing and you still weren't quite ready to write it off, then you would just leave it on the balance sheet. So that can be a little bit complex to get your head around, and we will run through some examples if that would help, of how to actually facilitate those transactions. But just for a summary of what we've talked about today, so a bad debt is when there's no agreement with your customer to not pay, there's no error, there's no credit being offered, you are expecting payment from your customer or client, they haven't paid you, that is then a bad debt. And the difference that we have is either we can write it off as a bad debt, completely remove it from the accounts and stop chasing it, or if we're not ready to write it off from the accounts, but we think it's unlikely that we'll get paid, then we can create a provision for bad debts in the balance sheet, move it out in the profit and loss for that period, so that it doesn't count as towards the taxable profit for that year. Hopefully that helps. Thank you very much for watching, and as I mentioned, if you haven't already, please subscribe to our channel. Thank you. Goodbye.